To our discussion today. Thank you for your time. I want to thank also ResPublica and the CFA for organising and hosting the event today around an issue which I think is close to many people's hearts, and that is the whole concept of the squeezed middle and the extent to which people are trying to mitigate the financial pressures under which they find themselves through alternative forms of lending, borrowing, access to credit. Now, ResPublica, you will all know and love dearly, an independent, non-party political think tank, which is really driving forward some of the radical ideas, and which, as you can see from the string above our heads, has a reputation of hanging its speakers out to dry, and I'm sure that will be the case today. And the CFA, the Credit Finance Association, a trade body, which is representing the essentially the high-cost, short-term lending market, which is a fair description, I think. My own role here is I'm a chair of a charity, a financial capability, financial education charity called Credit Action. My name, as you can see, is Chris Pond, and we have been working quite closely with the CFA in terms of the booklets you've got on your chairs to see how we can make sure that what we perceive to be quite an important part of the overall landscape of lending is nevertheless there in such a way that consumers and policymakers can have confidence that this is a form of responsible lending, and I'll come back to that in a moment. I have other hats which I wear, as well as chairing the Credit Action charity. I'm also chair of a standards board on equity release. And there again, there are some parallels here, because equity release as a concept could be one mechanism for helping us to meet many of the public policy goals, whether it's closing the retirement income gap, whether it's meeting the cost of long-term care, or just of one generation being able to help out the next generation to get on the housing ladder. But it has to be in the context of very strong consumer protection. And I think therefore, in terms of the type of lending we're talking about in this session today, or something like equity release, the issues are very much the same. And the reason that that protection is so important is, of course, because financial services across the board have lost people's trust. I have to say that as somebody, amongst a number of offences which I have to ask you to take into consideration, I was previously at the Financial Services Authority as their Director of Financial Capability, and before that I was a member of Parliament, but we won't go into that. But it is very important in the context in which trust in mainstream financial services has been badly damaged, that we both have to rebuild that trust, because those financial services are not only essential to the UK economy, but are also essential in terms of helping all of us manage our lives. But also we need to recognise that people are looking for alternatives in terms of the forms of credit available, whether that be peer-to-peer lending, whether it be microfinance, whether it be in the form of things like equity release. And I was struck a couple of years ago to hear one of the big hardware retailers telling us that the sales of home safes had increased dramatically because people no longer trusted the banks to be a safe place for them to put their savings, and the mattress didn't feel terribly safe either. So we have got to rebuild that trust, and we have to think also about a changed landscape of financial provision, and that's what we will be discussing today, whether or not we can actually accommodate those changes which are coming about. Now, we have a very distinguished panel for you to open our discussions on that, but I would emphasise it is about opening discussions, because there's also much expertise sitting that side of the room as well. We do have Ben Gummer, Member of Parliament for Ipswich, and who's a member of the Regulatory Reform Committee. We have Guy Opperman, MP for Hexham, who's Parliamentary Private Secretary to the Ministry of State for Immigration. We have over here Anna Ellison, who is Research Director of Policis and has done a great deal of very valuable work on financial services, not only for CFA but also for the FSA, and in a number of other contexts where she and her team can provide us a really solid basis of fact on which we can build the argument. And we have Russell Hamblin-Boone, who is the Chief Executive of the CFA and therefore one of our hosts today. Russell has only been in the job, he tells me, for 7 weeks, having previously been at the FLA, and I'm delighted also to see that John Lamedy is here, and John, many of you will know, who was Russell's predecessor and did so much to try to get the balance of argument around payday lending onto a secure footing. Now, I don't want this to be a debate about payday lending, is it good or is it bad? I want us to take a broader framework than that. I want us to think about the way in which financial services are evolving and the different forms of lending and credit which is becoming available. So, could I first of all ask Guy to open our discussions for us? And I think you're going to be talking about community-based banking, Guy. So, over to you. Thank you.
I do feel slightly like I am at an EasyJet convention, clad in orange and about to discuss the relative rates of pay of Stavros or whoever is presently in charge of EasyJet. Others may choose to sit, but I'm actually going to stand, not least because I think you'll be able to hear me better if I stand up and talk to you like this. So, I am the MP for Hexham. I was a jockey previously. I was a fat jockey before you all ask, surely you look 5'11" and with an arse like a water buffalo. It is true.
Do you want to just take the microphone from Chris?
How's that? Okay, better. I was a very fat jockey and not very technically proficient. I then ran a business with my dad, which was engineering businesses in both the south and in Concert, and I was a barrister for the best part of 20 years. I was elected, to the surprise of both of myself and the people of Hexham, in May 2010, and was in a position then that did the standard constituency thing that the three of us all do, which businesses would come to us, businesses would say, I've had a bad debtor, I've had someone go bust on me, it's not my fault, I've done £40,000 of work with that particular business, and I'm now in a position that I've got a cash flow crisis. I would have breached this business then, and this has happened to me repeatedly, I point out, my business then breaches its overdraft lending facility. It then gets into the bad debt regime and what is called credit risk, and then they come to me and say, but our bank are now saying our £40,000 overdraft or our £50,000 overdraft we breached, and now the first thing the bank has done is it has actually reduced that overdraft facility down to £20,000, even though it's not my fault and even though I've banked with them for 20 years. The consequence of that is I do what MPs do, and I'm sure Ben has got similar experiences. And I went to see the bank manager locally, and then went to see the bank manager in Newcastle. And both of them could not do anything to help me, because once you're in credit risk, you're in credit risk. And the computer effectively says, no, we can't help. I then went down to a rather large and faceless building near Leatherhead. There's another one at Nottingham where the credit risk team is based. Spoke to certain people, and they said, we can't do anything about it. You need to go and speak to the, well, frankly, the chairman of this particular bank and get him to change the rules. I then went to speak to the main board, and of course, they say, well, that's just what the computer system says, and that's, of course, we've got credit risk rules like that. And about 3 weeks later, my business went under, and 32 people lost their jobs. It is a standard story, whether you're dealing with small SMEs or big companies. Now, how do we change that? I have spent a large proportion of the last 2.5 years in the House of Commons pursuing the cause of local banking. If you ask yourself, why is it that the German economy is so much better than every other economy in the rest of Europe? In my opinion, one of the main reasons is that 70% of bank lending in Germany is by local banks. 70%. Whereas about 98% of bank lending is done by the big six in this country. All of whom, as we all know, painfully to our cost, some of which banks we now own, are in difficulties to a lesser or greater degree. The local bank system in Germany involves the following basic principles. You can only invest locally within your region, so it would be Northumberland or the Northeast. You can only, your local bank manager has the decision-making powers. So it's not a case that you're going into credit risk, it's not the case that you're going to be, somebody else is going to make the decision for you. It's that bank manager who's in charge of both the lending and then actually making sure that business survives. And he's an extremely important person in a way that the present bank manager system in Northumberland or any of our local areas is not important, with no disrespect to those individuals. Finally, those local banks give their profits, to a degree, back to the community. And there is a sense of cooperative, obviously, but also ownership by the local people. They actually are empowered by the local banking system because they feel it is working for them. And I see the proliferation of local banks gradually coming through, and it is coming through. If I give you a couple of easy examples in the time I've got at the moment. On the 12th of March of this year, I met with Hector Sanz, the head of the FSA, with Andrew Tyree, the head of the Treasury Select Committee. We had about a 2-hour meeting, and the product of that meeting is that we made the point to him that although banks have been set up in this country, Metro is the best example, from scratch, and Metro is very, very successful. Metro has more, I'm not an advert for them, but I am a big fan of what they're doing. They have more people applying for bank accounts to Metro than all the other big six banks put together. Metro is open 8 till 8, it's open on the weekends, Saturdays, Sundays. It's just transformative of banking in my view. And going forward, Metro cost a lot to set up, so it's quite difficult to set up and it needed a lot of private equity. However, Sanz made it very clear to me, and we then read it into the record of the House of Commons when, on the 23rd of April of this year, we had the Financial Services Bill, that setting up a smaller local bank with 10, 20 million pounds worth of capital and assets, that would be much easier, and they would do a far less regulatory approach to make it that much easier to set up. Consequently, you see banks like the Hampshire Bank and other organisations setting up, and my hope is that is going to expand, and it is going to be the case that there will be proliferation. And Clause 5 of the new Financial Services Bill makes it specifically clear that competition is to be encouraged from smaller entrants to the banking market. It can only be a good thing. There are many things that are changing in the way that financial services are being provided, but for me, the idea of local banks is the way forward. Thank you.
Thank you very much, Guy. Now I'm going to ask Ben Gummer if he will say a few words about the role of consumer responsibility in this. And just before you do, Ben, I think we need to put the context of this, that people are going to be asked to take on a lot more responsibility for their own financial affairs. Universal credit, which I'm very much in support of, will nevertheless require people to think about managing their money in a way which has not been the case previously. For people who have been used to weekly or fortnightly budgeting now suddenly have to budget over a month. We've got the changes in housing benefit, which means that it's paid direct to the tenant rather than to the landlord, and again requires some real budgeting. And it's one of the reasons why I agreed to chair a working group for the Centre for Social Justice in Duncan Smith's Centre for Social Justice to look at issues of financial capability and about how we avoid people slipping into debt through mismanagement of their funds. So, Ben, if you can take us further on that, that would be much welcome.
I'm going to do the same as Guy, because I respect him. And thank you very much, Chris. I want to talk both about consumer responsibility and also about consumer saving, and I'll explain why consumer saving when we're talking about debt in a second. It has been noticeable for my constituents. I represent a constituency which is almost a perfect slice through the United Kingdom demography in terms of socioeconomic breakdown, age, race, ethnicity, and so on. And you can get a very good feel, therefore, for what the trends are saying, what the figures are saying for the country as a whole. I get as personal stories on the doorstep every day that I'm in the constituency, which is most days. And what has been clear over the last few years as this recession has continued is the real impact of the effect of living standards having stalled and then contracted slightly over the last few years. People who would go for a curry twice a month now go once every 2 months. People who would have had 1.5 holidays now have just one weekend away. It's a kind of significant change in people's standard of living, which I think we as politicians have to kind of understand and respect and reflect in a way that I think we probably have not so far. And the reason I say that is because most people understand why they're having to do that and why our living standards have been under pressure over the last few years. And they also understand that we are, as a nation, having to tighten our belts and live within our means. This is a national effort, and one, hopefully, that at the end we will come out with a stronger economy that is more robust. And in the same way that we are doing it in the national finances at the moment, it is important also that I think we kind of rediscover a sense of personal responsibility to do with how we all look after our own finances. Now, Chris, you're entirely right that if I can repeat something that our leader said a few years ago, when he said if you treat people like children, then it's not surprising the way that people respond. That if people are not encouraged to behave like they would be if they were in a job and being paid at the end of each month, then of course it's going to be difficult to prepare people for the workplace, especially if they've been out for a long time. But it's all right just saying that as a politician, but you've actually got to do something about it and make it possible. And that is why a lot of the work, I should say that Guy and others have been doing in Parliament around financial education is so important, and one that we really, really need to get into schools from the earliest age. And I'm completely behind what Michael Gove has been saying to do with allowing head teachers as much as possible and schools to set their own curriculum and not to be too prescriptive. But this is a plea really to the teaching profession, that one of the things that we really, really need to do if we're going to get a society and build a strong society in the future is to encourage, right from the earliest stage, is to see numeracy through the lens of personal financial management, because that is most people's daily experience of numeracy in any case. So it is relevant in two ways. But beyond that, I just want to make a comment about debt and consumer debt over the last few years. When people have been making so little money in the bank on savings, I think that we've got to be realistic about why people have spent so much money as consumers. Now, there are lots of reasons why. ResPublica have talked about this at length. But actually, when you're not getting much out of your savings, and it's fundamentally a boring thing to be doing, it is not surprising that people, when they have got a bit of extra cash, spend it, and then perhaps they spend it a little more than they would do or could afford to do so otherwise. And I think we've got to rediscover local saving. I want to talk about local consumer saving in the way that Guy has been talking about local business saving. I don't know how many of you know about Funding Circle, where you've got effectively kind of social clouding of funding for small businesses. What a fantastic idea. Why can't we do that on a local basis? Because after all, people like investing and like being interested in things which are local. They can touch them, they know the people who are involved, they know the shop at the end of the road or the factory in the centre of town. Why can we not do local funding circles, giving local authorities the ability to delegate regulatory powers to them so that they can actually, up to a certain capital limit, can regulate that funding, that social exchange, and do the same for local equity markets, again on a very local scale, so that I can invest in my business at the end of the road that I know that I know the owner, the person starting up, even if it's 100 quid or 150 quid or 200 quid. Spread your risk, and you can actually get an interesting savings product put towards people rather than effectively arbitraging between decimal percentage points on the internet on our main high street banks, which is a fundamentally boring way of managing your own money. So 2 ideas, local funding circles for lending, local exchanges just made simple for small cap, very small cap companies, regulated perhaps under delegated powers to local authorities, so that you actually start to get that living, breathing municipalism that built this city and the many great cities in Britain in the late 18th and 19th centuries. One final thing. Credit unions, again, something that has been talked about by this think tank at great length. We've got 1.5 million people without a bank account in this country. The ability of credit unions to provide those people with banking facilities needs real concentration by the government. I know that we have started off on a good step with credit unions, but it's something which I think we should be focusing far more in the months and years ahead. And with that, I will shut up.
Thank you for that, and especially for the point about the need for financial education at the earlier stages. And I'm delighted that the second largest all-party parliamentary group at the moment is the financial education group, driving to get that into the curriculum. I'll let you guess which the largest all-party parliamentary group is.
Real Ale?
Yeah, you got it. Well, at least we're in their slipstream there, so we may see some big changes. Now, Ellison, as I explained earlier, is the I was going to say the mistress of, but it doesn't quite work as well as the master of evidence-based policy making, particularly on issues around financial services, and particularly in respect of those lower income and more vulnerable groups and their relationship with financial services. So, Anna, could you give us your insight?
Use the walking.
Okay. Well, I was asked to provide some kind of context around the growth of alternative lending and some sense of scale on some of the effects. And I think it's reasonably well known that there's been something of a shrinking of supply of mainstream credit across the board in this country, and that's particularly affected some of the sort of the squeezed middle, those on sort of low and modest incomes. And actually, the shrinking of the supply of credit to those on sort of modest incomes, the squeezed middle, started prior to the financial crisis. The real peak of credit card lending was around 2005, and it followed a long period of expansion of particularly credit card, revolving credit and overdrafts to those on low-paid workers and higher-risk borrowers through the late 90s into the early 2000s. And after 2005, 2004, because the losses were beginning to come through on that kind of business, lenders really began to change their underwriting criteria. But the point I want to make is that actually the growth of alternative lending, and particularly of short-term lending, is not actually only about credit supply. It's actually part of a response to a reaction against some of the developments that have occurred in mainstream credit. And I'd just like to tell you a little bit about some of that to give you a sense of scale. First of all, it's worth saying there's something like 13 million people in the UK who are revolving credit on credit cards. But 10% of those, and 29% of those in the bottom 50% of household incomes, and are actually making minimum payments on their credit cards. And half of those making minimum payments have been doing so for more than 2 years, and 1 in 5 have been doing so for more than 5 years. And a third of card users, who are in the bottom 50% of household incomes, have been making minimum payments for 3 years or more. That's quite a significant number. When we look at overdrafts, now the whole overdraft regime, and in particular the way that the overdraft limits and the over-limit fees and the penalty charges on overdrafts have worked over the last few years, have to a large extent meant that those on low incomes have been subsidising the free and credit banking model that the rest of us benefit from. If we again just take those overdraft users in the bottom 50% of household incomes, and we're talking about a large slug of the population here, 31% of the population have an overdraft, but if we're looking at the bottom 50%, almost 6 in 10, 57%, have paid over limit fees on their overdrafts. Almost 2/3 of those, 63% in the last year, and of those who have been exposed to over limit fees, the average is 6 a year. So you can see that actually adds up to significant costs in running mainstream credit. If taking the population as a whole, not just credit users, 9% of the population are currently either cycling overdraft or credit card debt that they can't pay down and using it to fund core spending, or they're making minimum payments on credit cards. That together is 5.3 million people who are cycling credit or overdraft debt and using it for core spending, support core spending, everyday spending all the time. Credit card debt is something like 37% of all debt, but it's an even larger share of problem debt. And taking those who consulted debt advice on a nationally representative sample, 6 in 10 had been making minimum payments on their credit cards for an extended period before they did so, and 56% had an overdraft that they can't pay down. Clearly, people who recycle payday loans and who roll over their payday loans multiple times are also incurring very high costs on their credit. But it's worth saying that between 4 and 5% of the population are using payday lending, and around, based on and this is research with the big lenders, based on the big lenders that are members of the CFA, around 3 in 10 of those are rolling over a loan, and those that do so are rolling over a loan 2.1 times. The reason I told you some of that is I want to try and explain to you that the perception that mainstream credit is cheap and alternative lending, payday borrowing is very high cost. Actually, the picture's much more complicated than that, because it depends on the behaviour of the individual using the products. So let me give you a couple of examples. If we take a payday loan, and the average payday loan being £275, if you pay it to term, and it's a bricks and mortar model, it's going to cost you £20 a 100. If you're borrowing online, it's going to cost you on average £25 per 100. If you roll it over for the 90 days, I take our 2.1 times, it's going to cost you somewhere in the region of between £60 and £75 per 100. However, using an overdraft which should cost you £10 a 100, you don't incur any charges, and now we're talking about an overdraft of the same scale as the average payday loan. That would rise to £29 per 100 if you just had 3 over limit charges a year, and bearing in mind the numbers that were incurring over limit fees, but it would rise to £38 per 100 if you had 7 charges per year. And let's look also at credit cards. So if you were borrowing on the average balance for those on low incomes, bottom 50% of household income, making minimum payments for the average length of time that those on low incomes who make minimum payments for 18 months, and you're looking at £44 per 100 for making minimum payments on that balance, and that will rise to £78 per 100 if the minimum payments are made for 3 years. But the critical difference, and this is one of the reasons why behaviours are changing, is that in the first instance, even if it has cost you your £75 per 100, you have paid off your debt after 90 days. In the examples I just gave you, for the 18-month example, you will have paid nearly £1,000 off your for your 1,800 balance that you started with, but you will still owe £1,565 at the end of the 18 months. If you keep that up for 3 years, you will have paid a little over £2,000 on your starting £1,800 balance, and you will still owe £1,300. And it's those kind of dynamics that have actually driven the way that people make choices about revolving credit and short-term credit. Essentially, the balance of cost and risk is very fine, and a great deal of it depends on your behaviour in using the product. So, just want to say three things really. That it's really important when considering all the policy issues and choices around high-cost credit and mainstream credit to understand that actually that balance is very complex, and that the solutions need to be nuanced, and they need to be based on the reality of what consumer costs, what the risks and costs that people actually face in using credit products. And what people actually need is a diverse range of products in the market, with both short-term and long-term products, and both high APR and low APR products, so that they can choose a product that actually fits with the balance of costs and risks and their own circumstances and the problems that they are the problems, or indeed the aspirations that they're using credit to address. And that's my 5 minutes on the soapbox.
Thanks very much, Anna, and for underlining the fact that we are dealing here with great complexities, and also that the behaviour of individual consumers will really determine the outcome, which again, I'm afraid, comes back to the financial education issue. That although financial services is very good as an industry at shaping its products to what it knows about consumer behaviour, particularly the tendency for people not to cancel a rather good deal on perhaps savings, which has got a bonus at the beginning once that bonus has disappeared. But it's very, very important that we as individuals know what is happening in this market, and that we can't simply take the line, okay, well, conventional lending is cheap and payday lending is expensive, which leads me, therefore, to Russell to have the final word from the panel for just 5 minutes, if you would, Russell, as Chief Executive of the CFA.
Thank you. Well, as Chris said, I'm new to the CFA. I'm not new to consumer credit. And I thought it'd be helpful if I just share with you some of my experience of short-term lending, or what's more popularly known as payday lending. And as we've used the term here, I'll use it. I'll continue to use it. How much, in fact, do you think you know about payday lending? I won't ask for a show of hands, but I wonder how many people have actually used a payday loan, or visited a payday loan store, or used a website, or maybe you know someone who's used a payday loan. If you'd answer no to any of those questions, maybe I can help. Payday loans are short-term loans. They're used by a variety of people who either choose not to use other credit products, like credit cards and overdrafts, as Anna was talking about, or they can't access other forms of credit. 75% of the population use credit, and as Anna said, just 4% of them use payday loans. Now, if you were to take out a payday loan, you'd need to be over 18, you'd need to have a bank account, and you need to be working. You'd be subject to the same assessment as if you applied for any other form of credit, and possibly more. We'd need to look at your bank statement, your income, your financial commitments, your credit history, your proof of identification. In fact, one online lender uses over 30 pieces of data to decide if you can afford a loan. And even then you may get turned down. Online, just 9 out of 10 applicants are successful at getting a loan. And I've learned that there's a misconception about payday lenders who make that payday lenders make their money by keeping people in debt. You might say that of other lenders who might want to have a long-term relationship with their customers and who charge a range of fees and penalties. But it's important to note that CFA members don't want to lend to people who can't pay back a loan. Well, why would they? It's not good for business, and it's certainly not good for consumers. It costs money to recover debt, and with such small sums, it's not worth pursuing someone through the courts with the less than even chance that you'll get your money back. And the chance of getting repeat business from that customer or anyone they talk to are pretty slim as well. So my members are in the business of risk-based lending. They invest huge amounts in cutting-edge technology to help them make a calculated risk that they can lend to someone who may be financially stressed or can't get credit from the bank and still get their money back. And the evidence is that they're quite good at it. According to the Money Advice Service, only £1.20 of every £100 of problem debt is due to a payday loan. And if you visit a payday store, as I did, you'll find that the staff, as well as being well-trained and professional, will tell you that they know people in their community. They live in that community. They know who they can lend to and who will be turned down. You'll see that the stores look a lot like a bank. They're clean, bright and friendly. You'll find them on secondary high streets where rent and rates are a bit cheaper, and you'll see that they're employing people and they're supporting the local economy, where the alternative would be another boarded up empty space. I spoke to a young chap in one of my local payday loan shops in Yeovil who told me that the shop had been there 10 years. He told me how his training was extensive and was ongoing, and he felt that his was a good employer and that the people he served came from all walks of life. And I was struck by something he said. He was offended by people who use the term legal loan shark, and we know who we're talking about there, because he said you couldn't say what he did for a job was the same as those criminals who use violence and intimidation. And I have to say I share his anger about that. When I spoke to a manageress in Edinburgh, she told me about her regular customers who were business people who lost faith in the banks. Women whose husbands had worked offshore and used payday loans for those unforeseen circumstances. And one employee was a former banker who absolutely loved his new job because he could apply his knowledge of finance and learn new retail skills. So the reason people use payday loans, they tell us, is that they're simple and they're transparent. For people who are managing tight budgets, they know exactly how much they have to pay back, between £10 and £30 for every £100 borrowed, and there are no hidden fees or charges. If they use their overdraft or credit cards, it's more difficult to tell how much you actually owe until you get your credit card statement or your bank statement, which makes it difficult for some people to budget. And moving to the regulatory side of things, there's been a lot of noise about extended loans and rollovers. The CFA, along with the other trade associations in the sector, has made a commitment that its members won't extend rollovers more than 3 times. On average, as Anna said, people roll over twice. And it's important to note that rolling over is not an automatic right. Before a lender agrees to extend your loan, they'll conduct the whole same affordability assessment they made when you originally applied for the loan, and you won't necessarily get approved. And I think that's what's meant by responsible lending, making sure that we make the right decisions up front about whether someone can afford to pay back a loan, and making sure that we do all we can to help someone who's got into financial difficulty. And that's why we recently launched a code of practice, there are copies of it on your seats, that sets high standards and it demands best practice from our members. Our members appointed me because they wanted to reform their trade association. They wanted to set the bar high for the payday lending sector, and they want to encourage innovation and top quality customer service. I didn't go into this with my shut. I asked some demanding questions of them, and I'm starting to get the answers that I was hoping to hear. The finance sector is changing, we have to accept that. There are major changes to the regulatory framework, and there are big changes to the way financial services are going to be provided. Payday lenders want to be part of that post-credit crunch world, where banks are only one choice in a range of services, and we've heard about them from the other speakers, that help people in all circumstances managing their household finances. And we need to embrace that ambition, looking beyond the banks with an effective regulatory environment and with an open, non-emotive debate. Thank you.
Right, well, thank you all. That gives us a good framework for our discussion. We've got just under half an hour now to hear from your views on these issues, and we've had both, the themes here seem to be responsible lending on the one side and responsible borrowing on the other side. We've had Guy and Ben talking about that need for responsible lending on a community, locally based concept, both for businesses and for individual consumers, and Ben also talked about individual consumer responsibility, and then Anna underlined the importance of that in terms of the complexity of all of this and just how behaviour determines the costs. which I think led very well into Russell's presentation about the role of payday lending with all of this. Now, payday lending itself is emotive. We know it's up there in the debate. It certainly is in the House of Commons. Let's hear from you a response on any of the issues that's been raised by the panel. And would you mind saying who you are and where you're from? Just wait for the microphone.
There you go.
Helen Foreman, Reigate Banstead. We also run a small family-run financial services company now. I wanted to pick up on the point made at the beginning on teachers teaching numeracy through the budgeting lens. I had the fortune to be brought up by parents who were born before the Second World War. So I was brought up, and I brought up my own children who are now adults, to you don't spend what you haven't got. My experience of teachers, particularly those in the state school, is the government doesn't allow us to do this. They're naughty, you know, they're not allowing us to teach properly. And that is irresponsible, because it's saying some big organisation isn't allowing us to do something. They have had pensions that are far better than the rest of us. I worked in the pensions industry for 10 years in the 80s. Final salary increasing. The rest of us in final salary schemes haven't had those for many years, and they still whinge and whine about it. And it really makes me very frustrated. We all need to learn to live within our means. We all need to be responsible. And how do the panel suggest that we can put forward the unpopular thing, telling the teachers, please be responsible, please tell the parents you're in day-to-day contact with and the children you're in day-to-day contact with, say, we have a limited budget, we need to learn to live within these means, to make choices, and advertising, so that we can say to advertisers, don't buy what you can't afford. Not just don't get a credit card for what you can't afford. We heard from the lady Anna that everybody's perceptions of how they can, what they're going to spend their money on, the situation they find themselves in. We can't just draw a blank slate. But we need to do something to address the thing of everybody else has got it, therefore I must have it. Never mind the consequences, because I haven't thought of it.
Okay, thanks, Helen. Yes, sir.
Philip Blond. I was really excited by both what Guy and Ben talked about, genuinely excited, because for me the Treasury has missed a trick, and one of the tricks it's missed is it's gone for austerity, but it thought that the growth answer was a macro answer, but it isn't. And actually what you see now is the Treasury desperately attempting to restore some sort of local infrastructure. And what I was particularly excited about is where Ben talked about ways in which we can make saving interesting. That's the key behavioural point. Make it interesting, make it dynamic, link it to a local project. And that's where Guy's idea about local banking becomes so completely crucial. Because the fundamental problem we've got in this country is that the Treasury keeps thinking the pump is wrong. This is why all small business lending schemes have failed. But actually it's the circulatory system, it's the intermediary system. So is there some way, both Ben and Guy, that you could come together, because an active savings policy is the only thing that will make a local banking policy work, because that's where the credit will come from. So I guess what I'm asking is if MPs have such good ideas, could you not come together and help the Treasury
Gummer and Opperman for Chancellors.
Yes. My second question, and again, please correct me. I remember reading some research for the Community Finance Organisation, and they worked out in order to have a lending scheme to the poor that broke even, you'd have to charge something like 230%. Now that's from memory, that might not be accurate. Now that's a terrifyingly high proportion in order to break even on lending. So, you know, if the attacks on payday loans, or if the attacks on other loans to the poor are merited, then there's got to be some other alternative. But if you're charging 230%, what's so bad about the loan schemes that currently exist? So my question to the panel is, what is the most viable lending scheme for the very poor? And what would they suggest? Thank you.
Thank Oxford. I should have said a word from our founder, shouldn't I, really, there? I'm going to take one more before throwing to the panel, and then come for another round of questions. Thanks.
Thanks. I'm Seb Ellsworth from the social investment business. I think it'll build very much on Philip's point. Guy, I'm interested very much in what you talked about in terms of local banks and the German example. In the States, banks are encouraged and in some cases compelled to lend into local communities, particularly to private areas, through the Community Reinvestment Act. And I'm interested in the extent to which you think there's an opportunity for that here in the UK. And in terms of opportunities for making saving more interesting, social investment is a growing market, opportunities for people to gain both reasonably solid financial return and demonstrable social impacts for their local communities. And I'm interested in how we can encourage that further.
Okay, thanks. Three good points there. I'm going to ask Guy to respond first.
Can I deal with the first 2 points about numeracy teaching and making savings interesting? I have what I think is the perfect example. I have a primary school called Castle Primary School, which I went round, and the 7-year-old who gave me the tour of the school walked up to me and said, well, of course, we decide the budget here. And they don't do all the budget, it's true, but I don't want Michael Gove to get worried. But they do the best part of £50,000 worth of that primary school's budget. And she, as part of she's chair of the school council, in a primary school this is as well, they get together the kids, they decide what it is they think is important in the school, and then they authorise the spending, and I can assure you the head teacher then buys it. But she came to me and she said, do you see that whiteboard? We bought that. Miss Johnson, we couldn't actually see anything because it was a grey board previously. And the school has total respect for its premises. There's no graffiti, there's no problems. People who don't respect the individual furniture are really frowned upon. And you then get the concept of ownership that is so vital. The old line works best that, none of us ever washed a rental car, because why would you? We don't have any ownership of it. So I see it locally. There are teachers who are enabling, through things like school council, spending local money, that actually is teaching the process that we also want. Very briefly on viable lending schemes to the poor, I like very much that in the East End of Hexham, my Sure Start and what is called number 28 Derwent Street, which is run by the Community Foundation, is also the home of the credit union. And what you have is community support organisations, partially funded by government or by local third sector, then actually dovetailing and working with things like credit unions. I'm very interested about the idea of the American model, and we could perhaps have a chat about that.
Just on the issue of local investment, local saving, local credit. To repeat something I said yesterday, so I apologise to those who might have been both fringe, but growth is essentially an urban phenomenon, always has been. You go from the Renaissance cities through what's happening in China now, growth happens in cities and towns. And it happened here in Birmingham because people knew each other, they invested in each other, they lent to each other, and they actually wanted each other to succeed. They employed each other. It is a community activity. And we've got to try and recover that. We've got to find ways of getting community associations to work together, and whether that's by investing in each other or lending to each other. And I cannot agree more about social investment. I actually believe that we're on the cusp of a financial revolution with social investment. In 100 years' time, we'll look back at this as the seedlings of a second release of capital investment into areas that we would not have dreamt of 10, 15 years ago, and that is immensely exciting. And once the public and all of us have got our heads around it, because it's essentially a simple concept, but once we kind of get our heads around it, then we'll be away. And all power to you all both for doing that.
just responding to the point on financial education and the government not allowing us to teach properly, as it was put. I'm a chair of governors of my local primary school, and I feel very strongly about pastoral care is an important part of the curriculum, but I also understand the curriculum is a very crowded curriculum, and what we do is invite people, parents in to talk about what their jobs are, and to make working in a bank interesting, talk to children about the importance of money in what they do for their jobs. And I think one way of doing that is to integrate it into some things that are perhaps already in the curriculum or some of the extra curricular activities. In terms of what's the best lending scheme for the poor, I think I've probably made it very clear that the payday lending market is not a market that's targeting vulnerable people, and we're not looking to lend to people who are unable to pay back their debts. That's not the business model that CFA members operate to, and we welcome things like credit unions. I think it's important to have that level of competition in the market. In the same way, credit unions promote short-term lending, and I'm an advocate of short-term lending, so I think that's one option. Probably the straight answer for what's the best lending scheme for the poor is the one that helps them budget the best.
Okay, thanks, Russell. Let's have another round of comments from the floor. Yes, so you've been waiting patiently.
Hello? I'm very interested in what Ben and Guy said. My name's Tony Dalton, I'm from Warwickshire, and I'm a mentor, business mentor, and I've dealt with a lot of companies that have had the sort of problems Guy mentioned. I am fascinated about the local funding circle you suggested. Are there any legal restrictions to setting one up, or can it literally, or has that got to be kicked off by the local authority, or how do you get something like that working? Because I think local funding and local banks are the way out of this mess.
Right, thanks very much, Tony. I'm not sure if everybody heard that the question was about whether local funding circles can be set up without actually regulation as such. That's great. John Lamedy?
Hello, I'm John Lamedy, and Chris has kindly introduced me already. I think the answer to the gentleman's question here is, as long as you're not actually borrowing or you're not actually investing, you can set up a circle with minimal regulatory requirements. But the problem is, and I apologise profusely for bringing along this huge bucket of cold water, whilst I'm enormously enthusiastic about local borrowing and local investment, the simple fact is that the regulatory regime the government is bringing in denies that entirely. In order to lend, in order to invest, the organisation has to be authorised, and it will have to be authorised by the FCA. The FCA is planning to authorise between 25,000 and 27,000 firms. Today, we have at the moment 80,000 firms who have a consumer credit licence. So the whole regulatory regime is not moving towards small localism, it's moving towards large centralism. And I'd be very interested to know how we're going to square that circle.
Thanks, John. And there was somebody over here, I think. Yes, thank you, sir.
Thank you very much. Very intrigued to hear a lot of the comments from the panel. I myself was one of those bankers a few years ago and decided that banking was too popular, so I became a politician a couple of years ago. So, really, first of all, to repeat what my friend over here said, local funding circles sounds like a brilliant idea. Very keen to explore that, which I will do. But more than that, I remember a few years ago talking to a guy who'd been in banking for like 765 years, and he said, well, the borrower needs to understand what he's letting himself in for, and the lender needs to know how to get out. And actually, if we all think about that, whether we're borrowing or lending, and dare I say it, this goes right from private all the way up to government. We had a lovely speech from Osborne about how the previous government left him in a mess by borrowing too much. The answer's right the way through the economy. Yes, don't be afraid of borrowing, but make sure you know what you're doing, and make sure when you're lending, know what you're doing.
Absolutely, thank you. Yes.
Yeah, I can bring back the point you mentioned earlier with regard to the void of the poorest in the community with housing benefit being paid directly as well. I'm just concerned who's going to provide that immediate education to actually help people budget. I'm a North West councillor, and I'm really, really concerned about that real problem we're going to have with the implementation of the universal credit. Fully support it, the monthly payment, absolutely for it. Who is going to provide that education to help people budget correctly going forward?
Okay, we've got some other important points there. There's John's question about the changing regulatory structure moving away from localism and towards big centralisation. We've got that point about financial education again, and also particularly in the context of universal credit, which I think Ian Duncan-Smith is very well aware of, but we do need to have much more focus on how we're going to help people manage their money more effectively. And then we've got this issue about responsible borrowing as well as responsible lending. Anna, can I ask you to come in and briefly respond to some of those points?
Do you mind just
Yeah, sure.
I'd like to add a point about the appropriate institution for serving the very poor. I think one of the important things to say about that is it's not actually an institution that's only focused on the very poor, and that one of the things that credit unions will need to do is to widen their target audience so that they're attracting the savings of a wide spectrum of savers with reasonable deposits, and that actually borrowing, any borrowing model that focuses purely on the very poor is not attractive either to the very poor, nor is it viable. And I'd say that there's something else perhaps there in terms of credit unions, in that in order to really attract the social investment, the capital investment that will need to come on in perhaps after the new round of funding from the government, if credit unions are going to be sustainable, as the credit unions have possibly ducked one of the issues around the interest rates that credit unions may potentially be able to charge. At the moment, they're looking at increasing the rate to around 3%. Actually, have they actually ducked the issue? Should they actually have raised that, and to the point where actually it does become the kind of business that social investment funds could actually look at in order to really get the scale and put in the infrastructure that would be needed. The other point was more around the budgeting support that might be needed in terms of bringing in universal credit. We've just done some work for National Housing Federation, and we've done some work also for DWP around this, and it's sort of looking at the sort of scale of people who may actually struggle with the new regime, and it looks like something around a quarter of tenants of social tenants may actually need some real support in order to make that transition effectively to managing their funds on a monthly basis, and to be able to manage much larger sums over a longer period, which critically is the real challenge for them.
Thank you. And Ben.
I can't claim any great knowledge of financial regulation of funding circles, except for the fact there are already examples of this. There's Kiva as well, and there's no reason at all why you can't kind of brand geographical areas. I mean, I'm thinking about it. This is a new idea, so I'm going to try and develop it. But we do need to find a way of making people associate with their investments and also with their lending, because otherwise it doesn't mean very much. Can I just say something about teaching quickly, because the issue was raised in the first question. I think it's really important here, and it's especially important at a Conservative Party conference, to differentiate between what the leadership of the teaching union says and the capabilities of the many, many thousands of brilliant teachers out there who are fantastic and working hard every day. And in this context, remember also teaching assistants who are on very low wages, who know what it's like to have to live on a low wage, and they are in an excellent position, as are teachers who are middle incomes, to explain budgeting to the people that they are teaching. So I'm very confident that we can do this, no matter what we might hear from some of the heads of the NSUWT and NUT. If I could say that gently.
Private teachers over the last 30 years in Surrey, you just think,
Well, I don't accept your analysis as far as my experience, if you don't mind me saying so. Yeah. Anyway.
Thanks. Russell. No, sorry, Guy.
Oh, apparently it's me.
I'm going to give Russell the last word.
Then very briefly, I will simply say, the one thing the gentleman raised, I think John raised, that there was a lack of availability for local financial organisations on an ongoing basis, primarily by reason of government action. I wholeheartedly reject that, because I have in front of me the Financial Services Bill, Clause 5, which we passed on in April 2012, which specifically states that there should be an emphasis on the ease with which new entrants can enter the market and how far competition is encouraging innovation. I cannot think it is put any more crystal clear that government is making positive steps in a way that it can do through policy to enable local organisations and the appropriate credit facilities to become available.
Thanks very much. And Russell, the last word.
Just on the point that John was making about regulatory restrictions and things, I think what's important with the new Financial Conduct Authority coming into place, and the comments we've been hearing from Martin Wheatley about his product intervention, his shoot first, ask questions later policy, is an important one that we need to take note of, and MPs here should take note of. If we want innovation in the market, if we want new entrants, if we want new products that are adapted to the demand that we're seeing from consumers, the new financial services regime and the new the financial market that's coming about post-credit crunch, then we need to make sure that the regulatory environment allows that innovation and that product intervention isn't so extreme that there isn't the opportunity for all of these new products, whether they come from credit unions or they come from payday lenders or they come from other short-term lending sources.
Right, thanks, Russell. Well, thanks to our panellists. I'm sorry, we're going to have to wind up now.
Can I just ask one question, if I may, and take director's license here? One of the things, and I'm sure, Russell, you perhaps have already thought about this, but it seems to me that something like a payday loan facility is a crucial first step on establishing a credit record. And what would be really, I think, create win-wins, because I recognise what was interesting is nobody was able to come up with a cheap way of lending to the poor. So if loans to the poor of necessity have to come with a certain price, one of the interesting things would be to use your payday loan relationship to broker people in to forms of the next level of credit. And I think the real answer is peer-to-peer lending, and we already have that between wealthy people with good credit history. But if you could start to group your customers and take Ben's point about savings, then what payday loans could be, instead of a vilified part of the sector, they could be a gateway and a form of brokerage for a new type of re-endowing people with credit and credit worthiness, and also facilitating the saving and loans institutions that both Ben and Guy have spoken about. And I wonder if that's something you might consider.
I think, Philip, we're going to leave that as a suggestion. I'll get told off if I allow to go further. But it is it's a very important point. And equally, I was concerned that one mainstream lender has recently said that it will not consider people who have previously taken out a payday loan. I think, these issues must be judged on their merit. So can I thank Anna, Ben, Guy and Russell, our panellists. Can I thank ResPublica and CFA, and thank all of you, because some of the issues that have arisen here is, first of all, the common theme that regulation needs to adapt to those changing and diverse patterns of borrowing and lending, and particularly to the localism agenda, and also that we really are going to have to be serious about equipping people to manage their money more effectively, to take control of their finances, unless some of the grand schemes we have planned, including universal credit, are going to fall on their face unless we invest in that way. So thank you all for your time. Thanks for a good debate.